Good day, everyone. Trust you're doing well today. Today, we're talking about how the Nigerian bond market is controlling your money. So, have you ever wondered why it feels like everything in Nigeria is expensive? Why loans are expensive, why businesses struggle to expand, why your bank suddenly offers attractive fixed deposit rates, why money market funds seems to be performing better, even at this point in time, and why some investors are quietly making money while others are waiting for the stock market to take off. Most people think these things happen separately, but the truth of the matter is they don't. Behind all of them is one market that most Nigerians never pay attention to, the bond market. And here is the interesting part. The bond market is not just a place where investors buy government debts. No, it's actually a giant game. A game involving the federal government, the central bank, banks, pension fund, foreign investors, businesses, and even you. And right now, the game is shaping the future of Nigeria's economy. Now, let me show you what is really happening. Imagine the federal government walks into a room and says, I need money. The government needs money to build roads, of course, we all know that. They also need money to pay salaries, finance projects, and cover budget gaps. But the government doesn't actually print money and hope everything works out, right? Instead, it borrows. And who lends this money? Investors, banks, pension funds, foreign investors, regular Nigerians, like you and me. Now, here's where the game begins. The government wants to borrow as cheaply as possible. Investors want the highest return possible. At that point, both sides have, opposing interests, which is, technically opposite interests. The government wants lower interest rate. Investors want higher interest rate. And that's where the negotiation starts. But there is another powerful player sitting quietly in the room, the central bank. The central bank has a completely different mission. Its job is to control inflation and protect the value of the naira. Think about it for a second. The government wants cheaper borrowing. The central bank often wants higher interest rates to fight inflation. So even before investors enter the picture, there is already tension inside the system. Now, let me make this simple. Imagine inflation is running very high. Prices are rising practically everywhere. Food, transport, rent, practically everything, everything money can buy. Now, imagine the government offers investors a bond paying 10%. Would you buy it? Probably not, because inflation currently is at 15% and your investment earns only 10%. You are actually losing purchasing power. You are actually getting poorer, even though your money is growing on paper. This is why investors demand higher yields. Investors are actually trying to protect themselves, and this is exactly why bond yield in Nigeria have remained high. Investors are basically telling the government, if you want my money, pay me enough to compensate me for inflation and risk. Now, here is where things really get interesting, because when government bond yield becomes, very attractive, they start pulling money away from other investments. Let's say you earn around 20% from government-backed securities. A lot of investors start asking themselves a simple question: why take the risk of buying stocks? Why invest in a business? Why lend money to a company? Why take extra risk when government securities are already paying attractive returns? That single question changes everything, because money starts flowing into bonds, demand for stocks weakens, businesses find it harder to raise capital. The entire economy begins to feel the effect. But that's not even the biggest consequence. The biggest consequence happens right inside the banking system. Imagine you're a bank. You have two options. Option one, lend money to a business that might struggle to pay. Or option two, buy government bonds and collect attractive returns. Which option sounds safer? This is why many banks become, more interested in government securities when yield are high, because from a business perspective, this creates a problem. Companies need loans to expand. But when interest rates are very high, borrowing becomes painful. So a company that plans to expand may decide to wait, because technically it affects their capex. Now, a company that plans to hire more worker may, slow down. A company that plans to increase production may postpone its plan. This is one reason why interest rates, can, slow economic growth. Now, let's talk about another player that many Nigerians forget: pension fund. Every month, millions of Nigerians contribute to their retirement account. That money doesn't just sit somewhere. Pension fund managers invest it, and a large part of that money goes into government bonds. That means something very important. Even if you have never bought a bond in your life, There is a good chance that your retirement money is already heavily connected to the bond market. The performance of your pension is heavily influenced by what happens in the game. Now, let's bring foreign investors into the picture. Foreign investors have choices. They can decide to invest in Nigeria, they can decide to invest in America, they can decide to invest in South Africa, they can invest in Egypt, they can invest almost anywhere. So every day they ask one question: is Nigeria worth the risk? If they believe the answer is yes, money will flow into Nigeria, bond prices rise, yields may fall, the naira gets support, confidence improves. But if they become worried about inflation, exchange rate, or economic stability, they leave. And when large amount of money leaves, yield often rise. This is why confidence matters so much. Sometimes the biggest force in financial market is not money itself, it's confidence. Now let's look at what is most likely to happen going forward. There are three possible paths, right? The first path is the good scenario, which is inflation gradually falls. Now, when that happens, the central bank starts reducing interest rates, businesses begin borrowing more, economic activities improves, stocks become more attractive, growth picks up. Everyone doesn't win equally, but most players benefit. The second path is what I believe is the most realistic scenario. Inflation stays stubborn, which is technically most times you hear inflation is sticky. Now, when that happens, interest rate remains high for longer than people expect. Government securities remain attractive. Banks continue earning well from fixed income investment. Businesses continue facing expensive borrowing costs. Economic growth remain moderate, not a disaster, and not exciting either. Then there is the third path, which is the extreme scenario. Maybe oil prices fall sharply. In that case, government revenue weakens, the naira sharply comes under pressure, inflation rises again, investors become nervous, bond yields move even higher, borrowing becomes more expensive. This is the scenario policymakers want to avoid at any cost. So, what should regular Nigerian take away from all this? The biggest lesson is surprisingly simple. Most people spend all their time watching stock prices, but the bond market often tell you what is happening before everyone else notices. The bond market gives clue about inflation, it gives clue about interest rates, it gives clue about government finances, it gives clue about investor confidence. In many ways, or should I say in some way, think of it like the dashboard of the economy. And right now, that dashboard is telling us something important. The battle between inflation and interest rate is still the most important game in Nigeria economy. And as long as inflation remains high, investors will continue demanding higher yields. As long as yields remains high, borrowing will remain expensive. And as long as borrowing remains expensive, economic growth will face challenges. That is the game. And whether you are an investor, entrepreneur, banker, pension contributor, or someone simply trying to grow wealth, understanding this game gives you a huge advantage over most people because once you understand how the bond market works, you stop reacting to headlines, you start understanding the forces that actually moves the economy. And that's where you begin to get a clue to make smarter financial decisions. If you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.